Pay taxes now or pay taxes later. Choosing the wrong retirement account could literally cost you hundreds of thousands of dollars to the IRS. Here is the ultimate breakdown. You know you absolutely must invest for your future, but when you open an account, you are forced to make a massive, permanent mathematical decision. Today, we are settling the ultimate financial showdown: traditional versus Roth. We will decode the math, the traps, and the loopholes. Before we can crown a mathematical winner between the traditional IRA and the Roth IRA, we must establish exactly what an IRA is and why you absolutely need one to survive in the modern economy. IRA stands for Individual Retirement Account. The absolute most important word in that entire phrase is individual. Unlike a 401k, which is completely tethered to your employer, an IRA is 100% yours. It is sovereign financial territory. If you get fired tomorrow, or if you change jobs 5 times in the next decade, your IRA remains completely unaffected. You open it yourself directly through a major financial institution like Vanguard, Fidelity, or Charles Schwab. Because you own the account directly, you have total, unrestricted freedom. You are not forced to pick from a terrible corporate menu of high-fee mutual funds. Inside an IRA, you can buy any broad market index fund, any ETF, or any individual stock that exists on the global market. However, before we discuss taxes, I must address the most tragic mistake beginners make. Look at the diagram on this slide. An IRA is not an investment. If you open a Roth IRA today and transfer $7,000 into it, your money is not growing. An IRA is simply an empty plastic bucket with an invisible government-issued tax shield wrapped around it. To actually build wealth, you must manually log into the account and use that cash to buy assets, like an S&P 500 index fund, inside the bucket. Because this bucket is so incredibly powerful, the IRS strictly limits how much cash you can put into it every year. The massive million-dollar decision you face is this: do you want that bucket to be a traditional bucket or a Roth bucket? The difference between a traditional IRA and a Roth IRA has absolutely nothing to do with what investments you can buy. You can buy the exact same S&P 500 index funds in both accounts. They both grow and compound at the exact same rate. The entire difference comes down to one single massive question: exactly when do you want to pay the Internal Revenue Service? Do you want to pay taxes right now, or do you want to pay taxes 30 years from now? To understand this, look at the visual analogy on the screen. Imagine you are a farmer. You are holding a tiny handful of seeds in your hand today. You plant those seeds in the ground, you wait 30 years, and eventually those tiny seeds grow into a massive, sprawling orchard that produces millions of dollars worth of fruit. That is the harvest. The Internal Revenue Service is the landlord of the farm. The IRS legally demands that you pay a tax on your crops. But the government gives you a choice. They ask you a simple question: do you want us to calculate your tax bill based on the tiny handful of seeds you are holding right now? Or do you want us to wait 30 years and calculate your tax bill based on the massive multi-million-dollar harvest? You cannot avoid the IRS completely. Taxation is a mathematical certainty. But the U.S. tax code gives you the incredible superpower of choosing exactly when the tax strikes. If you choose to have the government wait and tax the massive harvest at the end of your life, you are choosing a traditional IRA. If you choose to pay the tax right now on the tiny seed and completely protect the massive harvest from the government forever, you're choosing a Roth IRA. Let us dive deep into the first option: the traditional IRA. The traditional IRA operates on a pre-tax basis. The entire marketing pitch and psychological appeal for this account is instant, immediate gratification. When you put money into a traditional IRA, the government gives you a massive tax deduction today. Look at the math on this slide. Let us say you earn a gross salary of $80,000 a year. You decide to max out your traditional IRA by depositing $7,000. When tax season arrives in April, you inform the IRS about this contribution. The IRS then mathematically subtracts that $7,000 from your total income. They legally pretend that you only made $73,000 this year. By lowering your official taxable income, you instantly save hundreds or potentially thousands of dollars on your tax bill right now. You successfully hid that money from the government today, but you must understand that the IRS is not a charity. They are not forgiving your taxes. They are simply delaying them. Inside the traditional bucket, your investments grow tax-deferred. You do not pay capital gains taxes while the money is compounding in the stock market. But eventually, you will turn 65 and you will need to retire. Here is the devastating catch. When you finally pull that massive pile of millions out of the traditional bucket to buy groceries or pay for housing, the government is waiting for you. The IRS treats every single dollar you withdraw from a traditional IRA as ordinary income. You are not just paying taxes on the initial $7,000 you put in. You are paying ordinary income tax on decades of massive compound growth. The government is taxing the harvest. If tax rates go up in the future, your retirement income could be completely decimated. The immediate tax deduction of the traditional IRA hides a dark mathematical trap that completely blindsides millions of retirees. This is the ultimate danger of choosing to tax the harvest. When you get a tax deduction today, you feel incredibly smart. But you must realize that you are simply kicking a massive financial can down the road. And as that can rolls down the road, it gathers compound interest. Look closely at the devastating math on this slide. Let us assume you diligently invest $7,000 a year into your traditional IRA for 30 straight years. Your total out-of-pocket contribution, the seed money, is $210,000. Because you invested in the S&P 500, the magic of compound interest exploded your account balance. When you retire, your bucket is worth $1.2 million. Here's the trap. The IRS does not just tax the $210,000 you put in. They tax the entire $1.2 million as ordinary income as you withdraw it. If you pull out $100,000 a year to live on, and your effective tax rate in retirement is 25%, you will end up paying $300,000 in pure taxes to the government over the course of your retirement. You successfully compounded your wealth, but you simultaneously compounded your tax liability. You partnered with the government, and the government gets 25% of your total lifetime growth. For young people with decades of compound interest ahead of them, choosing a traditional IRA is often a catastrophic mathematical error. Now we step into the ring with the undisputed heavyweight champion for the middle class, the Roth IRA. Named after Senator William Roth, who sponsored the legislation, this account requires you to sacrifice instant gratification for absolute long-term financial invincibility. The Roth IRA operates on a post-tax basis. When you deposit $7,000 into a Roth IRA, you get absolutely zero tax breaks today. None. The IRS does not care. The money goes into the bucket after taxes have already been ripped out of your paycheck. It hurts your immediate monthly cash flow slightly more because you are bearing the full weight of the tax burden right now. But the reward for taking the pain today is absolutely staggering. Because you already paid the IRS their cut on the money before it went into the bucket, they legally cannot touch it ever again. The money sits in the stock market and compounds for 30 or 40 years. When that $7,000 magically turns into $100,000 or $1 million and you withdraw it in retirement, it is 100% completely legally tax-free. If you have $2 million sitting in a traditional IRA, you might only actually own $1.5 million of it after taxes. The rest belongs to the government. But if you have $2 million sitting in a Roth IRA, every single physical penny belongs strictly to you. You do not even have to report it as taxable income on your tax return. For the average young or middle-class investor, the Roth IRA is the greatest legal wealth hack in the entire United States tax code. If you are having trouble visualizing the profound difference between these two accounts, let us look at the brutal, undeniable math of a 30-year simulation. Look closely at the data matrix on this slide. Imagine two highly disciplined investors. They both invest $7,000 a year into an S&P 500 index fund inside their IRA for exactly 30 years. Assuming a historical 8% return, both accounts will grow to roughly $800,000. The vast majority of that $800,000 is pure compound growth. It is money they did not physically work for. Now they both retire, and they both want to withdraw $80,000 a year to live a comfortable lifestyle. If you chose the traditional IRA, the IRS is waiting for you. They treat that $80,000 withdrawal as standard income. Assuming a moderate 22% tax bracket, you will owe the government $17,600 every single year in taxes. Over a 20-year retirement, you will hand the IRS over $350,000 of your hard-earned wealth. If you chose the Roth IRA, you make that exact same $80,000 withdrawal, but your tax bill is exactly $0.00. Over a 20-year retirement, you literally save $350,000 in pure taxes. By accepting the slight pain of paying taxes on the tiny $7,000 seed today, the Roth IRA shielded hundreds of thousands of dollars of compound growth from the government tomorrow. You locked in your tax rate on the smallest possible amount of money. If you are planning to build massive generational wealth to pass down to your children, you must be warned about a highly aggressive IRS mechanism called the RMD. This stands for Required Minimum Distributions. Remember, if you use a traditional IRA, the government gave you a tax break today, but they are patiently waiting to tax the harvest. But the IRS is not willing to wait forever. When you reach age 73, which is currently transitioning to age 75, the IRS triggers the RMD rule on all traditional IRAs. This rule legally forces you to withdraw a specific percentage of your retirement account every single year and pay ordinary income taxes on it. It does not matter if you are already living comfortably on a pension or other savings. It does not matter if the stock market is crashing and it's a terrible time to sell. The government physically forces you to drain your own account just so they can tax it. If you refuse, they hit you with an aggressive 25% penalty. You lose total control of your wealth. The Roth IRA is completely immune to this trap because the IRS already got their tax money from you decades ago when you made the deposit. They do not care what you do with the account. A Roth IRA has absolutely zero required minimum distributions during your lifetime. If you do not need the money, you can leave millions of dollars sitting in the Roth IRA aggressively compounding in the stock market until the day you die. You can pass that massive untaxed fortune directly to your heirs. Beyond the complex tax math, there is a massive behavioral difference between these two accounts regarding liquidity and emergency access. A major fear that stops beginners from investing is the fear of locking their money away completely. They think, if I put $7,000 into an IRA and I have a catastrophic emergency next year, I won't be able to access my cash. You must understand the rules of the penalty box. The magic number in the American tax code is 59.5. If you put your money into a traditional IRA, it is heavily locked down. If you panic and withdraw that money before age 59.5, the IRS will punish you. You will have to pay standard income taxes on the withdrawal, plus a devastating 10% early withdrawal penalty. Your wealth will be decimated, but the Roth IRA possesses a hidden superpower, the emergency hatch. Because you already paid taxes up front on the raw money you deposited, the seed money, the IRS is much more lenient. You can legally withdraw your exact contributions from a Roth IRA at any age, at any time, and for any reason, completely tax-free and penalty-free. If you put $7,000 in and it grows to $10,000, you can withdraw your original $7,000 without a single penalty. You just cannot touch the $3,000 of compound growth until you reach retirement age. While you should never treat retirement accounts as a primary emergency fund, knowing this escape hatch exists provides massive psychological peace of mind for young investors. Because the Roth IRA is undeniably the most powerful wealth-building tool for the vast majority of people, the United States government actively tries to restrict successful people from using it. The Roth IRA comes with strict income limits based on your MAGI, or Modified Adjusted Gross Income. The numbers adjust slightly every year for inflation, but currently, if you are a single filer making over roughly $161,000 or married making over $240,000, the IRS legally forbids you from depositing money directly into a Roth IRA. If you do it accidentally, you will face severe financial penalties. But do not panic. The wealthy bypass this rule every single year using a perfectly legal, IRS-approved loophole known as the Backdoor Roth IRA. Here's exactly how you execute the loophole. Look at the flowchart on your screen. While there are strict income limits to put money directly into a Roth IRA, there are absolutely zero income limits to put non-deductible cash into a traditional IRA. Anyone can do it. Step 1. You take your $7,000 and you deposit it into an empty traditional IRA bucket. You do not buy any stocks, you just let it sit as pure cash. Step 2. A few days later, you click a button in your brokerage account portal to trigger a Roth conversion. You legally convert the traditional bucket into the Roth bucket, effectively sliding the money through the back door. Because the money didn't grow while it was sitting as cash for 2 days, there are no taxes owed on the conversion. You have successfully bypassed the IRS income limits, and your high-income wealth will now grow 100% tax-free. So, which one should you actually open today? In the academic world of finance, the entire debate between traditional and Roth comes down to one single variable: your current tax bracket versus your future tax bracket. The mathematical rule is simple. If your tax bracket is lower today than it will be in retirement, you must choose Roth. If your tax bracket is higher today than it will be in retirement, you should choose traditional. For 90% of the population, the Roth IRA is the undisputed absolute winner. If you are in your 20s, 30s, or 40s, your current tax bracket is likely the lowest it will ever be in your entire life. As your career progresses, your income will naturally rise. You want to lock in and pay taxes today while your rate is relatively low. Furthermore, you must consider the massive macroeconomic threat: the United States national debt. Historically speaking, U.S. income tax rates are currently at extreme, unprecedented lows. With trillions of dollars in national debt, the government will eventually be forced to raise taxes on everyone to pay for it. If you put your money in a traditional IRA, you are placing a blind bet that taxes will not go up over the next 30 years. A Roth IRA completely immunizes you against future government tax hikes. The only people who mathematically benefit from a traditional IRA are those currently in their absolute peak earning years. If you are a corporate executive making $400,000 a year, getting destroyed by a 35% tax bracket, it makes perfect sense to use a traditional account to get a massive tax deduction today. But for everyone else, the Roth is the ultimate shield. The United States tax code was written to be intentionally confusing. The government uses complicated acronyms and massive penalties to intimidate everyday people. Because of this fear, millions of Americans experience analysis paralysis. They spend 5 years debating whether to open a traditional or a Roth, and as a result, they leave their money rotting in a checking account, completely missing out on half a decade of compound growth. Do not make that mistake. Action is infinitely more valuable than perfection. Yes, the Roth IRA is mathematically superior for the vast majority of the middle class because it protects your massive harvest from future taxation. But the brutal truth is this: whether you choose a traditional IRA or a Roth IRA, you are still making a fantastic financial decision. Both accounts legally shield your money from the devastating drag of annual capital gains taxes. Both accounts allow you to buy low-cost S&P 500 index funds and build generational wealth. The only truly catastrophic, unforgivable mistake is choosing to do nothing. Time is the only asset in the stock market that you can never buy back. Stop analyzing. Pick the bucket that fits your tax bracket, link your checking account, automate your monthly deposits, buy the index funds, and let the relentless power of compounding build your multi-million-dollar empire.